Let's shift gears and talk about the Nomura Outlook for 2021. Where are the big themes emerging? Where is there a pocket of opportunity? And what's the India strategy? Sonal Varma, Chief Economist, India and Asia ex-Japan, as well as Saion Mukherjee, India Strategist at Nomura, join in on the show. Thanks so much for taking the time out and being with us. Sonal, to begin with you, let's just talk about how you've looked at the overall valuation picture for the Indian equity markets, the kind of gush that we've seen of liquidity, and where India really stands this year.
Yeah, sure. I mean, let me start and maybe Stein can add more on this. I think globally, it's really, two factors have surprised. One, I think the pace of recovery has been much stronger than expected across the board, notwithstanding the more recent virus-led wobbles we are seeing in some of the developed economies. And two, I think particularly for India, the containment of COVID-19 has been a positive surprise. And that has enabled continued normalization in activity, because that's something that other economies have actually not enjoyed as much. There have been cases of virus picking up. And third, I think clearly the overall policy stimulus, monetary fiscal, has also been quite substantial. So it's a positive global environment, and particularly for India, given the virus containment and our view that the lagged effects of easy policy of India are yet to reflect in the growth numbers. We do think India's growth is going to outperform other countries in Asia this year. So on a calendar year basis for 2021, we are expecting growth of close to 12.8%, which is obviously partly base effects driven, but I think also more from a fundamental standpoint is a fairly solid growth number to have.
Okay, fair enough. That's the view coming in. Meantime, Saion, let's understand what the outlook is, as well as to how you've looked at, India stacking up vis-a-vis some of the other emerging markets, and what exactly is going to be the outlook when it comes to the big themes to play.
Yeah, hi. So as far as, we have seen, significant rally in the Indian market, and as Sonal mentioned, I think the recovery has been strong. And also, I think, besides the liquidity that we have seen coming into India, we have corporate earnings. There was a fair bit of pessimism at the start of the fiscal year as the pandemic was unfolding. I think the corporate earnings, particularly from the second quarter, and now, of course, in the third quarter, we are seeing, a resilience in corporate earnings, and consensus estimates are going up. So therefore, we think that, to that extent, the stocks have done well. But when I look at the numbers for the next couple of years, because, as we go through this year, I think the markets will start factoring in what's going to happen in fiscal 23, for instance. So, I mean, we find the consensus is factoring in almost 20% earnings growth on a CAGR basis between fiscal 20 and 23. And in that context, I think it appears to be, pretty optimistic given, what we have seen in the last 4 or 5 years. Our concern is essentially, let's say, on rise in commodity prices, which can put pressure on margins for various companies. So if you look at the non-oil and gas, non-financial space, actually the EBITDA margin is actually at an all-time, at a decade high, actually. So there can be some potential risks there. So we would like to be somewhat kind of cautious and more selective in equities currently. So the key themes that we are looking at is essentially a deep cyclical recovery. So we are positive on specific banks where we see good valuation support. We are positive on infra construction space. I think that's one theme that should start playing out. And also we remain constructive on IT and pharmaceuticals, where there are structural growth stories from a medium-term perspective. And in the backdrop of the current liquidity environment, we would actually see valuation multiples in these sectors go higher from the current level.
Sure. Sonal, while what's dictating the FII deluge is, of course, the dollar weakness, and that's why, the foreign money is finding its way into emerging markets like India. But domestically, a big, event which is going to have a bearing on the way the markets are panning out is also low interest rates. When do you think in 2021 will we see the RBI rate trajectory actually moving upwards, or at least the interest rate trajectory stalling?
Yeah, that's a very important question actually for investors as we navigate 2021. And our view is we need to differentiate between the liquidity policy versus the rates policy of RBI. Because the rates policy is guided more with, where output gap is, inflation relative to target. And even though we are seeing a recovery right now, output gap is likely to be negative. So RBI is not in a rush to hike the repo rate. So on the repo rate side, we have rates on hold through this year. It's only in early 2022 when we expect repo rates to go up. But the former, which is the liquidity policy, is something we do think that the process of normalization is likely to begin very soon. The variable rate reverse repo option doesn't really tamper with the durable liquidity. But as we go forward, purely from a macro standpoint, as growth picks up and cost push pressures are picking up, there is a need to start to reduce the size of excess liquidity, durable excess liquidity that is there in the banking system. So that process will, of course, start with the CRR hike and reset, which happens in end of March. But post that also, the process of, gradually reducing liquidity to a still surplus but lower surplus will begin, which implies that the effective policy rate, which has been below reverse repo, now closer to reverse repo, gets closer to repo rate as the year progresses. So liquidity normalization to begin very shortly this year, but the actual repo rate hikes are still some time away.
Sure. The next big event, Sonal, of course, I don't know if it's going to be market moving or not, because there is no need for any announcements when it comes to capital markets. But nonetheless, it's going to be the budget. From purely a market as well as economy standpoint, what are the three priorities that you think that the government is going to be focusing on?
Well, I think from an economics standpoint, number one, there are still sectors which have not completely normalized. So while we are talking of a recovery, we need to, of course, understand that so far what India has seen is more of a normalization back to pre-pandemic levels. We're not back to the growth rates that were there pre-pandemic in terms of trends. So we are still in that, phase over zone, and therefore there are still some segments that need policy support, whether it's more allocation towards rural employment guarantee or specific support for the MSMEs or the services sector. So that's one. Second, this is a year where the rollout of vaccines implies there will need to be a larger allocation for health. And this is, of course, extremely important, even from an economic recovery perspective, because as we know that, as vaccines do become more widely distributed, the confidence effects will play up. As you know, consumers have rather increased their precautionary savings because of the uncertainty, and that uncertainty should come down as these vaccine rollouts happen. So this is going to be quite important. Third, from a more medium-term perspective, the durable spending on infrastructure, greater allocation there, I think that's something that the government has highlighted as part of the national infrastructure pipeline. So how much allocations are made there, that would be important as well. Let me also add a fourth. I think from the fixed income investors standpoint, there'll also be a question of how soon the government gets back to the medium-term fiscal consolidation path, because obviously, there's been, more than doubling of the fiscal deficit this year. But what's the timeline over which India gradually goes back to fiscal consolidation path? So that'll be a focus as well.
Saion, wanted to understand your outlook when it comes to the financial sector. While the view continues to remain that elevated NPAs do remain a challenge for the space, what do you believe will be the silver lining? How are you expecting earnings to shape up within the financial space, and where do the preferences lie?
Yeah, so we do see opportunities in the financial space, particularly in the context of where the valuations are. So obviously, if you look at post the pandemic, there were a lot of concerns on the asset quality side. What we now see is essentially things are a lot better than what was earlier anticipated. And, companies have already made enough provisions for that. So I think one thing which we are seeing is actually the credit cost is undershooting, and that would probably continue in the near term. Of course, we have to watch out what happens from a slightly medium-term perspective, how that plays out. But at least in the near term, that looks pretty good. And also, we are seeing some of the banks which are well capitalized, and we are seeing growth coming back in these banks, and they are gaining market share. So therefore, I think the well-run, well-capitalized banks are actually likely to surprise on the upside. As far as earnings is concerned in the near term. And, we are at an overall level positive and overweight on the financial space.
Okay, that's the view coming in on financials, but how have you read into the top tier IT companies' commentary as well as the kind of earnings growth? Does Infosys continue to remain a favorite?
Yeah, that's true. I mean, we have been positive on IT through last year, but as the stocks had rallied, we reduced our weight gradually there. So our argument, and if you look at the quarterly results also, they have been better than expectations on the revenue front. Almost 100 basis point better growth on a sequential basis. Margins also 100 basis point better. We are aware of large deal wins, which kind of give visibility to growth over the medium term. What I'm looking forward to is that, the structural change in growth can potentially surprise on the upside. I mean, there is, of course, some expectation which is already there in the stock prices. But as that plays out, we think there is scope for multiples to expand in the sector. Particularly in the context of the kind of liquidity environment that we have currently.
Sonal, wanted to understand what your view is when it comes to the Reserve Bank, the kind of stance that they're likely to maintain. Owing to the kind of inflation numbers that have come in, as well as what we've seen on the other macroeconomic indicators, as things are starting to resume normalcy, do you believe that the Reserve Bank will maintain a fairly accommodative stance going into this year as well?
This year, of course, is a long way to go still. I think what the Monetary Policy Committee sort of committed to back in December, which is, in fact, back in October last year, which is to maintain an accommodative stance at least into the next financial year, does imply that at least for the February policy and most likely even for the April policy, the accommodative monetary policy stance, yes, will be maintained. I think from a more 6 to 12 month perspective, though the macro dynamics, as I mentioned earlier, are changing, our view is growth is likely to surprise positively. And for the financial year 22, we are looking at a growth number which is above 13% on a real basis. So this is base effects driven partly, but not entirely. On the private sector side, we do think there will be a faster pickup, particularly as vaccinations pick up both in the developed world as well as in India. And two, on the inflation side, we have seen headline inflation, in fact, come down to close to 4.5% thanks to a collapse in vegetable prices. But the underlying price pressures are surely building up with the pickup in global commodity prices and as demand is picking up in India. There is a risk that because of pricing power, we see a greater pass-through in the coming quarters. So from the central bank's perspective, we do think they are going to adopt sort of a hierarchy in terms of how they manage their policy. The first step is more in terms of allowing some of the regulatory dispensations to expire. The liquidity side has to be gradually normalized, and the starting point from a durable liquidity perspective is the CRR hike that happens in end of March. But I think even beyond that, the banking system liquidity cannot stay at these levels because the economy is no longer in crisis level. Third, the policy stance, which we do think will stay at neutral into April. Sometime after June, July, there is a chance in our view that the stance also shifts to neutral from accommodative. And finally, the final step will be an actual hike in the repo rate. We do think that's more likely in first half of 2022 calendar year, which is when we are expecting a 50 basis point in hike. So I think if you take a step back, the economy was in a crisis. A lot of crisis response took place. The economy is starting to normalize, and therefore a lot of the policy measures will be normalized, but at a calibrated pace.
Right. Thank you so much, Sonal, as well as Saion, for joining in and giving us a 360-degree view on the economic parameters, as well as what the outlook is for the markets and where we're seeing opportunity. Let's take a very quick break with news that we're at 14,305 on the index, 2.4% down for the mid-caps.